Hello everyone, welcome back to Believer Science Academy. This is topic of the day discussion session. In this session, we'll be discussing a very important topic, that is decoupling India's growth slowdown. Okay, we will see why India's growth is slowing down. It used to be it was flying high, it was soaring high so many times in the last previous years, but in the last 3-4 years, what is happening is we are seeing slowdown in India's growth. Okay, that is from 8% growth estimation to almost 4%, 3%, 5%. We will see what is the reasons for this and what are the policy recommendations provided. So current growth scenario is there is obviously a decline in the growth rate. That is, according to National Statistics Office has estimated India's real GDP growth rate at 6.4% for 2024 to 2025, which has down from 8.2% in 2024. Okay, almost a 2% reduction in the growth rate within a year. This figure is below the 6.57% projection made in the economic survey of 2023-24 and lower than the 10.5% nominal GDP growth estimate in the union budget. Okay, so the all is not going according to the plan. We estimated, or the government had estimated, that India will be going at a rate of 6.5 to 7% over the period of next year, but that is not happening. So it is a cause of concern for us. So there have been criticism from the international organizations like IMF and World Bank over the data discrepancies. Okay, what is the data discrepancy in the GDP estimation? Economists and the institutions like IMF have raised concerns over the use of wholesale price index as a deflator in GDP estimates. Okay, so what is GDP deflator? GDP deflator is nominal GDP divided by the real GDP. How do you find out the real GDP? Real GDP is found out by adjusting it to the inflation. Okay, nominal GDP will be adjusted to the inflation and then you will find the real GDP. Okay, so this inflation in global standard is normally used by producer price index or consumer price index, because they consider studying inflation at the producer level or studying inflation at the consumer level is more suited for more suited for describing GDP deflator or the real GDP. But in India, we are using wholesale price index. That is, discrepancies are arriving because of this wholesale price index, because inflation at the wholesale price index and the inflation at the consumer price index, there is a huge gap. The gap is maybe because of the influence of retailers, maybe because of the influence of the sellers, maybe they are going to add extra amount to the selling, they are going to add transportation cost, etc., etc. As a result, there is a large discrepancy between WPI and CPI. So the economist, there is a significant divergence between WPI and CPI, that is consumer price index rates, has led to inconsistencies in the nominal GDP as well as the real GDP calculations. Okay, so institutions like IMF have said that it is better for India to adjust it at consumer price index. That is going to give you a better estimation of GDP. But we have been practicing WPI, so it will be going on. And also in the video we will see what are the challenges in private investment. Okay, why there is a slowdown in GDP. One of the main reason is challenges in private investment. That is, there is a sluggish corporate investment, meaning despite the corporate tax cuts in 2019, private investment in key sectors like machinery and intellectual property remains weak. Okay, before 2019 there was a significant event, that is after 2019 there was a significant event, that is lockdown due to COVID-19. So there were corporate cuts so that industries can come and invest in India, private players can come and invest in India and invest in important sectors. But post 2019 there have been a trend that private investment is there, but the investment is less in key sectors such as machinery and IPR. Okay, and the majority of private investments are skewed towards dwellings and other buildings and structures. Okay, they are focusing more on building the properties rather than investing in working properties, reflecting an unhealthy mix. Okay, so this is the reason, or this is the cause, one of the cause for the sluggish growth of GDP. Then comparison with UPI era. Under this, during the UPI regime, that is from 2004 to 2014, the real private investment grew at 10% annually, outpacing the public investment. Whereas under the NDA government, private investment growth slowed to 6.3%, which is slightly below the public investment of 6.6%. As a result, the public investment has reduced, private investment has reduced. As a result, there is less scope for investment, there is less scope for production, there is less scope for growth of GDP. Then, post-pandemic recovery, while the private investment rebounded in 2021-22 due to a base effect, the sustained structural changes in private sector behavior have been elusive. Okay, because 2019 to 20 was the year of COVID-19, so there was not much of any economic activities. Okay, so that economic, because of no much economic activities, whatever the GDP growth was there in 2021-2022 in comparison to COVID-19 felt like a big growth. Okay, felt like the growth was, or recovery was very high because of the base effect. But now the structural changes or the structural issues in private sector investment are now coming into the fore again, saying that growth between 2019-2020 and between 2020-21 or 2021-22 are just merely because of the base effect, but not because of the recovery of the economy. Then the sectoral analysis, there have been divergent performances. Okay, in sectors. In manufacturing, it showed double-digit growth in early 23-24, but has since slowed down. Okay, in mining, power and construction has experienced significant slowdowns as well. In services like retail, trade, transport, finance and real estate have shown deceleration as well. Okay, they have also reduced. And in public administration and defense, the only sector projected to grow faster in 2024-25, underscoring the role of public spending. Okay, get the trend here. Manufacturing, mining and services are the areas where private investment is very significant. Okay, since private investment is reducing, since private investment is sluggish, the growth in these sectors is also less, is also decelerating. Whereas in public administration and defense, the major investor here is public investment. Okay, because it has a government backing, public investment will regular. As a result, these sectors are showing positive growth. Okay, then fiscal strains. In the video, we see that there are revenue shortfalls. That is, as per the report, as of November 2024, only 56% of the net tax revenue targets for 24-25 have been achieved, while non-tax revenues reached 78% due to a surplus transfer from RBI. Okay, this is high only because of the surplus which is transferred from the RBI. So even in the revenue, there is a shortfalls. In both in revenue, non-tax revenue as well as tax revenues, there is a shortfall. Then impact on expenditure, that is, by November 2024, less than half of the 11.11 trillion capex target had been spent, disrupting the public investment plans. Okay, only less than half, that is almost 5.5 trillion has been spent only, compared to what was initially needed to be spent for this capex. Okay, capital expenditure. Okay, meaning half of is only spent on capital expenditure and rest is spent on revenue expenditure, which is not creating any kind of assets there. Then policy recommendations, that is the report tries to provide certain policy recommendations, that is, it asks the government to focus on revenue mobilization. How? Rework taxation policies to increase taxes on wealth and profits, enabling higher public spending on infrastructure and the welfare programs, and then encouraging private investment. How? By strengthening incentives for private sector investments in productive assets, particularly in manufacturing and intellectual property. Okay, these areas where the private investment is more necessary. So they should be encouraged by providing certain tax incentives or any benefits. Then enhancing public spending. How? By focusing on capital expenditure in sectors like infrastructure and renewable energy to stimulate economic growth. Okay. Then data and statistical reforms is also needed. Okay. That is by replacing WPI based deflator with the producer price index deflator for more accurate estimates. Okay, we have already discussed our producer price index on our recent videos. If you want to check out about producer price index, what is its difference between WPI and CPI, how is it important, and who uses these important indices, we have already made a video. You can check out previous days news analysis. Okay, on our channel. Then ensuring regular updates to GDP methodologies to reflect real-time economic changes. So there, if those are the short-term considerations, there are certain long-term considerations also, which focus on bringing reforms in structure, that is structural reforms. By introducing policies to improve ease of doing business and reducing bureaucratic delays and approvals. Okay, so ease of doing business should be improved so that more investment can come to India, and we have to reduce this bureaucratic attitude, that bureaucratic delays, that is red tapeism, crony capitalism, all these corruption, etc., activities should be reduced. Then enhancing credit access for small and medium enterprises to stimulate broad-based economic growth. Okay, focus should be based on small and medium enterprises. It will have more economic benefit because it is going to generate employment as well as economic growth. Then there should also be global integration, that is boosting exports through trade agreements and incentivizing manufacturing under programs like production linked incentive. Then focusing on consumption, that is strengthening rural demand through direct income support and employment generation schemes like MGNREGA. All these things should be considered in the long term so that we can regain the lost economic growth. So in conclusion, we can say that India's economic growth faces challenges from inconsistent private investments, sectoral slowdowns, and fiscal pressures. In order to overcome this, a balanced approach combining enhanced revenue mobilization, targeted public spending, and robust private and sector incentives is very essential. Then addressing the statistical discrepancies and adopting a long-term considerations can pave the way for sustainable economic growth. Okay, so very important topic. There can easily be a question on reasons behind the growth of economic slowdown. There can easily be questions or discussion on reasons behind economic slowdown in India during your interview also. So make note of these important points. Okay, so this ends our discussion today. If you like the video, then please hit the like button, comment on the video, and also share with your friends. And if you're new to the channel, please subscribe to the channel and also click on the bell icon so that you don't miss any notification. With this, I will end the video. Jai Hind.